Welcome to HYCM Insight with myself, Giles Cochran, Chief Currency Analyst. Now, the market move for the session ahead is as follows. The latest Reserve Bank of New Zealand rate decision has seen an important change that's significant. Now, the first interest rate hike has now been brought forward to 2022. This is a bullish development for the New Zealand dollar. It also saw rhetoric from the RBNZ saying that they could use negative interest rates disappear from their communication. This shift was unexpected, but not a total surprise, as the recent data out of New Zealand has shown some good strength. Retail sales at the start of this week, for instance, surprised to the upside, coming in at 2.5% versus minus 1.6% previous. This decision by the RBNZ saw immediate New Zealand dollar strength. Now, there is a contrast and a divergence between the RBNZ and the RBA. The Reserve Bank of Australia is trying to target very low unemployment levels and look unlikely to be able to reach these levels of around 4%, it's currently 5.5%, until about 2024 before increasing interest rates. So that means there is a divergence in place now with the Reserve Bank of Australia and the Reserve Bank of New Zealand. The bond yield spread, seen here in yellow, between the Australian 10-year bond and the New Zealand 10-year bond has fallen sharply post the RBNZ decision. That does indicate that there's more downside in the Australian dollar, New Zealand dollar pair ahead, and therefore there's a near-term selling bias for the Australian dollar, New Zealand dollar, and any rallies you would expect to find sellers. Now, what's the trade risk? Any significant shift in central bank policy from the RBA or the RBNZ would potentially negate this outlook, and any sharp pick up in COVID-19 cases or strong data divergence between the RBA and the RBNZ's respective countries would also negate this outlook.